Hello and welcome to the Accendo Traders Group. This is our weekend wrap-up trading plan for March 20th, 2010. Our website is blog.accendotrader.com, where we put together effective video technical analysis trading plans on a daily basis. Trading plans keep us focused and disciplined and keep us abreast of what's coming down the market that will affect our open trades. And as we scan for new trades, we can try to position ourselves on the right side of the market. But more importantly, it cuts down our research time so we have time to spend with our family. So the week that was. Certainly, it's nice to see that the market ended up once again. Of course, again, when you look at it, you can see that we're up 117 and 6 points on the NASDAQ and 9 on the. Those are what we like to see in a day. So for a week, it's still not that great, but it's still nice to see that we were up. And of course, when we look at the charts, we'll see that Friday's action did impact the potential positive of the week. So yes, once again, the markets are continuing to press forward. We're hitting the highest levels that we've seen in more than a year. The catalyst this week basically was, as we talked about last week, being the FOMC policy. From that, we've got 9 out of the 10 sectors ending up in the positive sector, led by industrials and telecom. The laggard was energy sector. But for the most part, again, the catalyst for this week was the FOMC policy. Now, the thing is, the FOMC decided to stay the course. So there was nothing dramatically different. There were no surprises in the statement. But the market rebounded or reacted well to that. So from Tuesday, we kind of went up, and Wednesday went up, and then Thursday was a pause day, and then Friday was the retracement back. Also in the FOMC policy statement, we continue to have one Fed chief, the one out of Kansas City, who's now dissenting against keeping the rates where they are. So don't know how long that means we're going to stay here. But again, the market did react well to the decision. Economic data didn't have any impact on the market. You know, we had PPI come in lower than expected. Initial jobless claims came in right at what was expected, so no movement there. As far as corporate news and earnings, Boeing talked about its one of its clients, Air Berlin, canceled an order for the 787 Dreamliners. General Electric said that their losses are going to be capped. They're finally going to get to the top of these losses this year. And FedEx had better than expected earning results. But overall, again, none of that moved the market. The big thing was the FOMC decision, policy decision. So we got nothing on Monday. So again, maybe we'll see if this sell-off on Friday will continue. We did have quadruple witching on Friday with options. Existing home sales, crude inventory. What you can see is that maybe Friday's GDP estimates for the third quarter may be what could be a catalyst. Nothing really that big on this that's going to move the market except for possibly on Friday. So again, going on to Monday, we don't have any economic news. We don't have any earnings that's really going to impact the market on Monday or the week. We have Adobe, Darden's restaurant, Lennar, but nothing really big. And you can see our split plays. So let's go ahead and move to the charts. I do want to take a quick look at the internals before we get to the charts, and just to see a couple things. First of all, when we look at Tuesday's reaction, right here, Tuesday's reaction of the FOMC, you can see we did get a volume pickup, which is great, which led to a nice bullish breath. You can see the breath right here, which is, again, pretty good also. Also, what I want you to see is both Thursday's action, and you can see the volume went down. And remember, Thursday was basically a doji, and we'll see that when we get to the charts. But I also want you to see Friday. Look at the volume on Friday. Volume 200%. I mean, yes, the volume went down a couple days here, but the volume doubled on Friday. And we know that although we're only down 37, we were down more. So was this volume keeping the market up, or was this volume ready for a key reversal? And we'll talk about that when we get to the charts. You can see the breadth again on Thursday and Friday. Definitely negative as on the doji, and negative on the but with a 200% volume and only have 2.5. I hate to say 2.5. Anything below 50 is bearish, but you would think this would be at 0.03 with that type of volume. You can see that on Thursday and Friday also that the new highs and new lows, the advanced decliners also went negative on Thursday and Friday. But we are still having stocks making new highs. Look how strong that number is. We're up to a 7 and 10. So stocks are making new highs, but are we making new highs at the top? Again, looking for key reversals. So we'll look at all of that now on the charts. So now we are going to look at the chart, and the first thing that should be jumping out at you is right here, and that is our candle for Friday's action. And as we said during the internals that it was about 200%, and you can see why it does look like it was over 200%. Well above average, well above our recent volume. We haven't seen anything like this in a long while. Here's one from way back in December. So what does this mean? Is this people notice that we for a moment that we had our key reversal day, we were below the low of Thursday, and then we kind of came back. So is the volume the battle of the bulls coming in and protecting and keeping us up, or is the volume just how negative the day was? Is this a key reversal? The other thing that we'll see as we click on our chart here is we can see that the January highs kind of act as support of where we close on Friday. So let's switch over to the S&P 500. On the S&P, we see the same thing with the extra large candle for Friday's action. We're a little bit closer to a reversal pattern here because we can see the low is right at, well, first of all, it is a bearish engulfing candle with our hammer from Thursday, so it is a key reversal on the S&P, but we don't take out Wednesday's action, and more importantly, we have yet to break the January highs. So we still have the potential support coming in here at the 1150 range of the January highs. So that'll be, and you can see that's at the 10 moving average. So that should be interesting if we do retrace back. And finally, the Nasdaq. The Nasdaq, we can see the January highs, not a problem. We do see a key reversal. We did take out the low of Thursday and Friday. So again, this 2325 range. Let's see if that acts as support. We did get a little bounce at the 10 moving average, but the January highs for the Nasdaq sit at the 20 moving average. What does all that do for our monthly charts? Well, for the Nasdaq, we're still okay. We're still above the 50 moving average. We said that was a key psychological area. We also talked about last week this range right here of the 1784. That was our target. That was our swing high from 05, swing low from 06. Where are we pausing at? So that's certainly interesting. So we need to break through this so we can get up to the next level, which gets us up to about 11,300, 11,400. So we need to break above this 10,700 range to continue to move higher. So we're still bullish, let's go to the S&P 500. And here's where we see the everything hitting the fan, where the rubber is meeting the turf. Are we going to stay above the 50 moving average? I mean, that's what it's all about. Are we going to stay there? We're right at resistance of the push down here, some swing action over here. We're all there. So are we going to be able to get that psychological boost of closing above the 50 moving average on the S&P 500? Finally, the Nasdaq, which is the strongest of the three. And here, we're well above the 50 moving average. And our resistance is coming in with some of this 06 swing high, 07 swing low. That's kind of where we're finding a little resistance. But we're so close. I mean, look how far the Nasdaq is from actually getting back up here to the 07 highs. We've certainly come a long way from the March lows. As we begin the education part of our video, we're going to readdress what we talked about last week, which is finding a trading system that fits you. One of the mistakes that a lot of traders make, again, is following other people. And I know that sounds hypocritical because I want people to follow me. I get that. But what's different is I also want people to make educated decisions. And that's the problem with trading system. Most of the trading systems out there work. The problem is they work for the person who created them. And will you trade it the exact same way that that person who created the system? Can you pull the trigger? If it takes on more risk than you're willing to take, then you won't trade it the same way. And then you might complain that it didn't work. Well, it worked, but it worked for that person. So that's why it's so important that when you are looking for a trading system, when you are developing your trade system, you got to take in your own personal trading style, your own personal risk tolerance, your own personal goals, and find one that matches your style of a trader. Otherwise, you won't enact it the way it's supposed to, and you won't make the money that you need to make. So you guys know about our futures trading room. You can see the results for the week. Did green all day, so we certainly recommend that. We got a great futures broker for you where you can get $300 E-mini margins and 20 free contracts if you sign up through us. And we have a futures platform and a futures system for you. Guys, remember you can lose all your money, so trade at your own risk, and I'll see you guys next time.